I have no idea if the stock market actually just bottomed or not. I really did just buy $8,000 of these 7 stocks, which I'll tell you exactly what I bought at the end of this video, so stick around. And the point of the title is that it does not matter if we're at the bottom or not. If you're a long-term investor, if you add to your portfolio every 2 weeks or every month or whatever, and you have a sustainable path to adding to your portfolio over time, if we're invested for more than the next 5 years, I think now is a great time to be buying stocks, and that is exactly what I've been doing. Here's my portfolio. We're at $95,680, and we are down $17,500 since February 16th, 2022. So it hasn't been great, but again, this is a long-term portfolio and I'm not concerned. And let's get into why I think we are at least closer to the bottom than the top, and then I'll get into the 2 new stocks that I added to the portfolio today. All right. The Fear and Greed Index, you've probably heard of this. It's just a barometer that measures where the market's at in terms of extreme fear all the way to extreme greed. What this does is it looks at 7 different indicators. Now, here's the thing. People might look at technical indicators and not want to trade when the market's weak or whatever. I don't do that stuff. I invest for the long term. And right now, the tone is fear versus greed. Greed was 2020, 2021, even early 2022. Now, we are in fear mode. Let's also look at just valuation metrics, right? We're looking now at fast graphs. This is back in December. We see the PE for the S&P 500 was up around 23, 24, which was just way high. This blue line is its average, really, over the last 20 years. And now we can see it has dropped below the blue line. And we can see over its history, it really has not dropped down to the orange line too many times, maybe 1, 2, 3, 4, 5. In the past 10 years, maybe 5 times, and we're getting down close to that. Now we're about 10% or so from hitting that orange line. So, yep, sure, we could go down, but I think we're closer to the bottom than the top. And then let's look at individual stocks, right? So Google had actually not held up very well, but it's a very solid company. And we can see it is now below its average PE since 2005, 2006. Apple was kind of one of the last ones to fall. It had held up so well, especially compared to other stocks. And it's still actually near its average PE ratio over time. So I still think the market could fall a little bit. Apple could fall a little bit if it falls in line with its average PE over the last 20 years or so. But we got to remember the profile of the business is a little bit different, so it probably deserves to trade at a higher PE multiple than it did back in 2012 through 2016 when they didn't have a lot of their higher margin software and services revenue. So they've got more of that now. It did get a bit extreme, obviously. So I think, again, PE ratio could come down a little bit, but I think we've found a relative bottom, at least in Apple, which is a big part of the S&P 500. All right, let's jump into the new stocks I bought. These are not recommendations. Do your own research, make your own decisions. This is Savvy Trader. I have a link down in the description. You can come here, you can see my portfolio, see how bad I'm losing to the Russell 2000. You can see how bad I'm losing to the S&P 500. You can compare the performance to indexes as well as other investors that you follow on Savvy Trader. And then you can get SMS and email updates of all my transactions, and you can see my portfolio here. I share the portfolio earlier from my brokerage just for that transparency to see that's the actual brokerage. But this is the best way that I found to actually update people and share real time when I add or sell something, which I don't do often. But whenever I buy something, it'll send updates if you subscribe. All right, so let's get into Taiwan Semi. We are looking at a chart back to 2004, which shows its earnings growth. Again, we are looking at the average PE, which is represented by this blue line. And we can see it was way above its average for a long time, pretty much since 2019. Now it has come way down, especially compared to forecasted earnings growth. Now, if we hit a recession, some global issues or something like that, these numbers could come down. But in my opinion, we have a relative level of safety or a good risk reward for entering a position in Taiwan Semi right now, because it's trading at a PE of 12, and it really has not traded at a PE of 12 since 2016. And even if we just go up to a PE of 16 based on expected earnings over the next couple of years, you're looking at a potential total return of 78% through December 31st, 2024 for annualized return of 30%. Okay, I don't know if we get there or not, but because of where the shares are trading at, I feel like we have a great margin of safety. Jumping over to Advanced Auto. Again, Advanced Auto has been a long-term winner. And if we go just up to that PE of 15, you're going to get a 21% annualized return through December 31st, 2024. All right, now we're looking at Simply Safe Dividends. I love this site for looking at dividend paying stocks, and we'll just quickly review some of the key factors, key traits about these two companies. So dividend yield for Taiwan Semi, 2.28. Dividend safety, they have them a 62 rating, which is safe but not super high. We'll talk about that in just a second. Dividend growth from 2020 to 21 was 10%. And this is why that dividend safety rating is safe but not very safe. It's got a 36% payout ratio, which they say is high for semiconductor firms. Forward payout ratio is 31%, so it goes down a little bit. 13-year dividend streak. They did cut their dividend in the recession. Again, the industry was a lot different back then. Recession sales minus 26%. Yeah, their sales will go down a bit in a recession. They've averaged 14% per year dividend growth over the last 10 years. And then again, just kind of showing that this is an opportune time to buy the stock. The 5-year average dividend is 2.14%. Current dividend yield is at 2.28%. When the dividend yield is higher, that means they've either increased it recently or the stock price is down, which makes the dividend yield go higher as long as they don't cut the dividend. And when you see that, it could be an indication that the stock is undervalued or there's something wrong with the business. I think the stock's undervalued. The 5-year average PE has been 19.4, and right now it's showing on this chart 10.5, which is very low from 19.4, much lower. Again, a low PE isn't necessarily an indicator that a stock is a good buy. It could be a deteriorating business. I think there's so many negatives right now out there about China, the semiconductor industry, all of this stuff that this is an opportune time to buy, and there's nothing structurally wrong with TSM's business. What gives me that confidence? Well, let's look at their EPS rising every year, basically since 2012. Their free cash flow is a little bit lumpy because of some of the investments, but still up huge since 2012. And here's where I'm not concerned about the dividend safety, right? The return on equity, they look for above 15%. They're at 34. Return on invested capital, they look for 12. They're at 25. Operating margin, they look for above 16. They're at 45%. Free cash flow margin, they look for above 5. They're at 8%. So again, they're doing just fine. Jumping over to Advanced Auto, so 3.5%, way above the 5-year average, but they've really juiced that dividend up there. 89 dividend rating, very safe. Again, it's showing 50% dividend growth, 40% payout ratio, 43% forward payout ratio, net debt to EBITDA, 1.77, which is low for most companies. Net debt to capital, 58%, it is high, so we have to monitor that. 15-year dividend streak, according to this. Recession dividend was maintained. Their recession sales were plus 3.9%. So again, this stock tends to, people don't buy new cars, but they still need to maintain the vehicles that they have. That's why I think this is a great stock into a recession or a recessionary environment. And then the return, they actually earned 4%. So who knows what happens in the next recession. Again, the dividend was pretty much a non-factor for a while, but just recently, really since 2019, they have really started dividend policy. Okay, they as well have grown earnings per share and free cash flow per share. That's a little bit more lumpy, but what they're doing, which I love, not for every company, but for them, is they are greatly reducing the shares outstanding, down from 74 million in 2012 down to 62 million over the last 12 months. And they are making good capital allocation decisions, shown by their return on equity, 18%, and return on invested capital at 11%. That's all I've got for you today. Have a good day out there. Stick to your process. And if you're a long-term investor, don't make short-term decisions.